This video is for entertainment purposes only and is not financial advice. Hey guys, welcome back to another video. My name is Josh, and in today's video I have Frank from the Investing with Frank YouTube channel perform an analysis on an ASX growth stock, Redbubble. So if you're a New Zealand based investor, Sharesies, one of the largest platforms in New Zealand, had started offering ASX stocks, so I thought now would be a good time to bring on Frank, who has experience investing on the ASX, talk about a growth stock on this channel. Now Frank is a value/growth investor focusing on microcap stocks, so as always make sure to smash as well as follow his channel. I'll leave a link to his channel in the video description down below, but without wasting too much time, let's get right into the video.
What's up guys, my name is Frank from the Investing with Frank YouTube channel. Today I'm going to talk to you about an Australian company called Redbubble. In this video I'm going to do a bit of a stock analysis and also a valuation. So if you want to see how I'm thinking about the intrinsic value of Redbubble, stick around till the end of the video. But before we jump into the video, I just wanted to say thank you Josh for having me on your channel. I really appreciate the opportunity. If you guys enjoyed, don't forget to smash that like button for the YouTube algorithm and subscribe to both Josh and my channel if you don't already. Okay, I just wanted to give you guys some context before watching this video. The day after I sent this video to Josh, Redbubble put out an announcement and was down 23% for the day. They went from $5.51 down to $4.24. That came from this announcement, a letter to shareholders. The main concern for the market, in my opinion, was a short-term problem. Their EBITDA margin that was around 9% was said to be dropping in the future to around 4 and 5%, which is going to be a problem for their earnings per share as well as their overall margins for their business, but only for the short term. The CEO said they're going to be reinvesting a lot of marketing going on, so a lot of operating expenses were going to go up. They're trying to improve these things you can see here, so their artist activation and retention, customer understanding, loyalty, brand development. I'll let you go and read this announcement if you are interested, but the main thing that hasn't changed is my long-term opinion on the company. They did say that EBITDA margin by 2024 would be back up over 10%, better than it actually was, and maybe up to 15%. So the long-term prospects of this business is still great, and nothing I said in this video has changed since this announcement. Overall, I think the case for Redbubble just got better. But let's jump right into the actual video and just keep this in mind while you're watching. Okay, so here is my write-up for Redbubble. We'll go through this and have a look at some of the fundamentals of the business before we move over to the discounted cash flow to look at the valuation of the business. But essentially, Redbubble have a market cap of 1.5 billion, enterprise value 1.4 billion, share price of $5.67. It actually came down a little bit now to about $5.50, and they trade under the ticker RBL on the Australian Stock Exchange. So they're an online marketplace is the essential aspect of the business. They have two websites, redbubble.com and tpublic.com. Most of their business comes from Redbubble, and TeePublic is very similar, it's just for t-shirts. That's the only main difference. But they're a three-sided marketplace between artists, customers, and fulfillment and operations. That fulfillment and operations team is unique to an online marketplace business. Usually they don't have that third aspect. So that's part of the appeal to Redbubble as a company, is that they do incorporate the fulfillment and operations team. So essentially it's a community of artists that sell their designs online onto products such as apparel, stationery, housewares, bags, and wall art. But they don't have to do that themselves. The artists can just post their graphic designs onto the website. Redbubble then have third-party operators, the fulfillment operation teams, that will go and create the product with that design on it, and then it is shipped off and delivered to the customer. So they're the three aspects of this business. We have the artists, loyal customers, and fulfillment and operations. I'll move down to that in just a second. They were founded in 2006. The founder is still part of the business. He's on the board at the moment, and they listed 5 years ago in 2016. Most of their business comes from the North America region, so that's important to consider. It is an Australian business, but over 2/3 of their revenue come from North America. Now, here is what they call the flywheel effect, which is a pretty popular term in investing, and a lot of growth investors like to look for this. The flywheel effect we have here, we have artists and content, loyal customers, fulfillment operations. The idea is that if you reinvest your capital into any aspect of this three-tiered business, the other aspects will also grow. So if you invested into finding more customers, for example, more marketing going out and those type of things, that's going to allow artists to put more content on. It will attract more artists to the website. Then there's going to be more production going on, so the fulfillment operations is going to grow as well. And that happens no matter where you reinvest, it's going to grow all of the business. So that flywheel effect leads to kind of accelerated growth, which is what we've seen from Redbubble over the past few years. That reinvestment opportunity is, in my opinion, it creates a reinvestment mode, which is fairly rare, and it's what I look for in businesses personally. You really want to find a business that can reinvest their capital for a long period of time. You want a long runway for growth. Because they have so many different ways to reinvest that capital, and they're a relatively small business at $1.5 billion, there's a long runway and a lot of reinvestment opportunities. Redbubble's closest public competitor is Etsy. So Etsy's a US company. They're a two-sided marketplace. They don't have that third side of the business, the fulfillment and operations. But other than that, they are a fairly similar model, and they definitely have fairly similar target markets. Their total addressable market is probably pretty similar as well, but they're not a print-on-demand service like Redbubble is. So they're not a perfect comp, but it's the best public comp that we have for Redbubble. So looking at their growth since 2012, compounded over that time period, Redbubble has grown sales at 54% per year. Now, they have diluted shares fairly significantly over that time period. Being a young tech stock, you often see a lot of dilution. Hopefully, as the company grows, that slows down moving forward. But we need to look on a per share basis for this company. So on a per share basis, since 2012, they've had a growth rate of 27%. Now, Etsy, for comparison, one of the biggest online marketplaces in the world, their sales grew at 48% over the same time period, so slightly lower than our 54%. On a per share basis, after dilution, we have a 22.7% growth rate, so also lower than Redbubble. So for a fairly unknown Australian company, it is pretty impressive that they have outperformed Etsy. Now, share price has not been the same for both companies. So although growth's been better for Redbubble, their share price has only gone up 326% over the past 5 years since listing, whereas over that same 5-year time period, Etsy has gone up 2,539%. So the share price has not reflected the growth for Redbubble. If you look back, you'll see that Redbubble has gone up fairly significantly. So if we jump over into our chart, you can see obviously last year during the pandemic, they took off. They were a stock that were clearly going to be a beneficiary from the shutdowns, and their share price responded. They've been almost a 3x over that time period. But before that, we've seen very little movement. So looking at the complete chart, they went almost nowhere for 4 years, even though they were growing sales at 50% per year, and then they somewhat got recognized by the market. But I would argue that this still does not reflect their true value. The one other thing I'll show you is this operating leverage taking place. So you can see over the time period, if you don't know what operating leverage is, this will give you a glimpse. Their SG&A, so their general admin expenses, is not growing at the same rate gross profit is. So they're growing their sales and their gross profit and trying to minimize their SG&A. That means our operating margin or our EBIT margin is going to grow. So you can see we had a negative EBIT margin, negative 12%, and then it's moved up into the positives. As this gross profit goes up and this SG&A is lower compared to our gross profit, our margins start to look better. So you can see in 2016, the SG&A was well and truly above our gross profit, but now it has overtaken that. So if you're looking at the income statement, you can see our operating margins go from the negatives, get slightly improved until we finally pop into these positive numbers. So that's also part of this reflection in share price, where we've jumped up 3x over a 12-month time period. So not just from the beneficiary to the COVID play, it's also reaching profitability and this operating leverage kicking in. So the next thing I want to jump into is the return on invested capital. Essentially, I think this is what they can grow at. Since they don't pay out any dividends and they have a lot of reinvestment opportunities, I think this realistically could be the growth rate for the business. I've put the multiple or the formulas here if you want to know how I calculate this return on invested capital, but I'll let you pause the video if you want to check that out. But we have a return on invested capital at 31.05%. Now jumping into the discounted cash flow. So this is how I'm thinking of valuing Redbubble at the moment. Now this is just my simplified discounted cash flow. It's not as complex as some others you might see. I know Josh has a great one he just put out on the channel in one of his more recent videos, which is pretty cool as well. Definitely go and check that out. But I've put in the shares outstanding, the ticker here. Free cash flow, this is their trailing 12 months free cash flow. I've got an exit multiple of 12. Arguably that is fairly low. I'll show you some different exit multiples to show you how that affects our margin of safety. I have a discount rate at 15%. That is just the return I want to see on my investments. Some people use lower. I know Josh uses 10%. That's the return he's aiming for, but you could use whatever you want. I'll adjust that as well in a moment so you can see how it affects our price. And the growth rates I've chosen are fairly conservative. Like I said, I think it's possible over the next couple of years that they grow at almost 30%, but I'm playing on the safe side as I don't know how people will respond once retail starts to reopen, so I'm going a bit lower. But over years 1 to 3, so the next 3 years, I'm going a 20% growth rate, and then I slow it down as we move further out into the future. The company gets bigger, competitors enter the space, and it becomes harder to predict. So I always make sure my growth rates become lower over time. Using these growth rates and this discount rate, we have a margin of safety at the moment of 13.5%. Again, I'll remind you this is not financial advice. Always go and do your own valuations and your own due diligence. Now, I'll show you how that changes if we muck around with our growth rates and our discount rates. So Josh looks for a 10% return. On that basis, we have a very large margin of safety at the moment, assuming you agree with these growth rates. I'm going to keep the 15% in there because I'm looking for a higher return. Exit multiple, you might think when you sell this company, you could sell it at 15 times free cash flow rather than 12, which would give us a 30% margin of safety. If you assume that the growth is better than I put in, so if we go with that 30%, suddenly the margin of safety looks a lot better again at 65%. I think the safer numbers to use though are closer to these type of growth rates where we really tear it off. We don't expect too much of the company. The exit multiple of 15, I used 12 originally. I think anywhere in that range you can feel pretty comfortable with. They're currently trading at about 20 times their free cash flow multiple, and they're fairly an unrecognized business. You would hope that you see some type of multiple expansion, which means you could sell at a much higher multiple. So again, that's going to reflect our margin of safety. But of course, go and do your own valuation as well.
Before ending this video, I just want to say a big thank you to Frank for his analysis on Redbubble. I think Redbubble is a really interesting growth stock on the ASX, and with the recent dip, it might be a buying opportunity. Personally, I don't own any shares in Redbubble yet, as I'm still researching the stock, and after Frank had brought Redbubble to my attention, it is a stock that I'm definitely interested in and will be doing more research into the stock, and I'll definitely let you guys know if I do decide to buy shares in Redbubble. So let me know what you think about Redbubble in the comment section down below, and make sure you subscribe to Frank's channel. You can find a link down below. But thanks guys for watching. Until next time, take care.